All right, Monday, 25th of March, 2024. This is the week ahead, brought to you by Financial Juice, New Squawk Services, and Earn to Trade, the best funded trader platform service. Let's get into it. Okay, so how's it going? Welcome to Monday, and this is the week ahead. So we're going to really look at just two articles from Twitter, just two charts, and then we're going to go technically look at these charts and see what's going on. All right, I'm really leaning more and more to the technical because the macro is not a trade. No matter how many articles you're aware of and how much breaking data you're aware of, I mean, it's just you have to be a slave to the technical. So, look, I'm not going to labor this point. Let's get over here and have a look. All right. So, first of all, we'll get a rundown on the week. We're looking at new home sales today at 2 p.m. GMT. CB consumer confidence tomorrow 2 p.m. Crude oil back to the half two marker. GDP is the biggest day Thursday for the US and initial jobless claims. So Jerome Powell did say that they aren't really, they're going to need to see the job situation get bad, and it's not getting anywhere near bad, right? But they're going to need to see something going on there before they're kind of incited into cuts, for example. And so I thought that was really important. And it did, as we talked about live at the time, it did then set us up to focus more on the continuing jobless claims, breaking or economic data, and the initial jobless claims economic data. So I think there's going to be fantastic trades and mispricings on these economic releases. We're going to get these 12:30 this Thursday. So do keep that in mind. And then Friday, it's Good Friday. No trade to be done. And we will get core PCE price index out year on year for the US as well. I won't be on here. The electronic markets will be open, but I suspect it'll be pretty quiet out there for the electronic trade, even with this tier one data coming out. You might see, a very busy half hour, but that'll be about it. All right, just two charts I really wanted to have a look at here, and I've been seeing this one come across the bow a couple of times, but this was shared by Deutsche Bank, and this is the concentration of stocks. So the top 10% of stocks by size versus the entire US stock market. So this is called the stock concentration. And so you're seeing here that this chart is actually now at new all-time highs. So on the hard left here of the chart, yes, that's right. You're looking at the 1929 crash era, just before 1929, 1931 crashes that we had. That was the last time we were up here. After that, when was the last time we tested almost around there? Well, it was a dot-com crash. And so we are above both of those levels actually at the moment. So just, people talk about bear porn and blah, 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 and people love to see the end of the world charts or forecasting the end of the world. Well, this is something to be looking at there. Now, do I think this means anything right now? No. Am I trading against this? No. Should you? No, definitely not. But it is nonetheless a really strong observation that the top 10% of stocks are now greater than the lower 75%. Okay, so that's kind of interesting. And another one here that just I don't get this. So Europeans don't really have these car payments. So this is the rate for car loans in the US, and that's 8.51% per year. All right, that's where that is at. Last time we were up here was about about 2000. So around the dot-com crash as well. You're seeing just in and around here, right? So right there. So I just thought that was interesting because fine, the economy's good, stocks are good, gold's up, crypto is up but coming back quite a bit, and so things are hot right now in the US, and you don't really want to be trying to sell these all-time highs essentially, and it's just very hard to get a day trade or a trade for the week on some of these markets. All right, enough of the chit chat on these markets or on these charts, and let's just get over and have a look here at the technical kind of observations across all these markets. Something that did kind of jump out at me from the blue was the dollar strength after FOMC and equities. As equities rallied over the FOMC, you initially did see weakness on the Dixie, but that then got wiped out. So I'll kind of go to the 30-minute here. So we initially did see, let's see, what can we do here? Let's just do that. Oh, yeah. Okay, here we are. So Wednesday, you saw that initial weakness come into the Dixie here over the data. You know, it was dovish, so down for a dollar, which is a risk asset, a risk off asset, and up with stocks, right? But then we held that weekly prior value area high the next day and just rallied up, and this is quite unexpected. This rally with the dollar joining in with stocks, feeling a bit left out. So you know the dollar is you just cannot go against the dollar. It's just super strong at the moment with that economy being super strong in the US. All right, I'll go in a row across the top here. We'll check in on Bitcoin. So we were looking at weekly bars last week, and that essentially had us up here. On the close, we were here. The market is essentially consolidating below this 69,146. So do keep that in mind if you're long or short. If you're long, you're probably swinging this from somewhere down around the 42s, which is a lovely area. I actually honestly thought we were going to go way down off the 42s, but we were suspended. Up we go. We found that support in the 59,448s there a couple of weeks ago. When was that? Back in start of March, 5th of March. And we haven't really had a good revisit of that. But I think, should we come back down again, I think it's going to break. And we may be looking for buyers down around 48, 120s. All right, that's all I want to do on Bitcoin. Then crossing over to NASDAQ, what we observed here last week, obviously from the dovish FOMC, up we go. And then, a little bit of calming off there on Thursday, Friday, just set to come back down now and into a bit of average pricing. But do keep an eye out for this price here, 18,372s. You see it on the 30 minutes. That is the high of this sort of consolidation area here, right? And if I just kind of show you the volume in this whole area from this sort of low here to here, you can see that there is a real point of control coming in at the 18,303s, but this high that we've marked off at the 18,372s is almost at a ledge point here. I think we could actually pull back a little bit and test the 18,364s. All right, so just let me wipe that there and we'll have a look, and that'll be 18,364s here. However, I wouldn't like to catch a falling knife here, and to be honest, for me, a trade on this would be a pullback in around 18,540s here, and sell that down. I don't know what the catalyst is going to be until we get to GDP. Now, as we recall GDP on Thursday, you need to bear in mind that if this GDP, and it's not going to come out soft, but if there is something in there that kind of looks like weakness, the market is going to trade down off of that. But I think GDP is going to come in, and we could be weak until we get to Thursday. And then we get strong GDP, and then we resume to the upside and probably cruise for a new all-time high on equities. Looking at the S&P 500, there was a fantastic opportunity in here. I'll just show that to you. On Wednesday on the speech, we had this lovely opportunity right here, just as Jerome was doing his Q&A. Actually, it was just after he started talking. The 52.46 is long. A couple of the guys getting on that one and looking for that upper target of the 53.17s. I didn't take that trade myself. Lovely trade though. Imbalance. Up we go. So you're looking at a weekly view up here. So we're holding below the prior day's value area high or low here, at the 52.92s, and I think we can easily come back down. Now, why is this? Why do I have this level down here? Well, I think once we come down to the 52.48s, there are definitely going to be buyers down here for sure, simply because that is a huge area of volumetric interest there. If I just kind of draw a volume profile here, I'm going to show you this whole area here, right? Look at this. You can see over on the left here, such an amount of volume buildup in this area, and then just into a bit of a shark bite above, which is kind of where we're trading through right now. Okay, so but should we touch down back into here, you can see that there's just this massive ledge here of value below, and I think the market could easily just turn on a dime and cruise for a new all-time high from there. Looking at the daily as well, you know that's even more pronounced here. You can see that ledge high is just there, you know, and we're really just going to spend a bit of time filling out what is a very low volume area here that we had over FOMC, right? Very low volume area, particularly this little zone here, which are kind of, I would argue, there actually. So you just got to trade down through that to that target to pick up the buyers. Anyway, that's it for the S&P. I'm not going to cover the Dow. Same though, we will look at gold because essentially we have that interesting area over here on gold. I can just actually show you that in isolation. You see here that there's a huge volume area coming in at 2164s, we'll call it. And you can see we're not able to spend that much time below there on Friday. All right, but ultimately I think gold is going to make its way back down to 2144s. But it's just a case of, you know, it's going to have to bounce off of this level probably one or more time. Ultimately, it's going to move with equities. So, you know, and T-notes. So T-notes would be your leading sort of indicator there for gold a lot of the time for a very good duration trade. But I think I'm going to leave this trade alone and really just trade oil this week, to be honest. And I'm not going to look to set the world on fire with equities at these high levels. It's just like, it's just so hard to trade them at the moment. So hard to trade them. I mean, if we look at the weekly on gold, you can see that the well, last week that was a low there. That was a low area of support. And we just breached it temporarily. So, you know, maybe we come down to the 2156s. Yeah, I mean, I'd be on board with that. 2156s for a long. But I'd like to have the positive GDP report out by then and then look for the long. So it's all a question of timing. You know, something, I don't know, something I've learned and something I've heard a lot of traders that I've worked with in the past that they've learned is, you know, that and it's very obvious, is that, you know, you could have the best analysis and the best concept in the world, but if your timing is wrong, you may as well just be bang wrong, full stop. And so, you know, keep that in mind when you're trying to run into a trade because you think you see something. You know, well, kind of wait until the volatility is gone out of it, or until, you know, the volatility just offers that mispricing for you to get in on your trade, you know. Anyway, here's oil. So essentially oil has kind of failed to hold over the 81.13s this morning, and I think we can easily kind of come down and probably test the 80.65s here. Now let's go back to the daily and kind of plan our strategy here. So what happened here last week was I was looking for that upper target. We hit that upper target, 83.57. So I actually was doing the analysis here on Sunday. Yeah, I think we were doing the analysis there just before we hit the 83.57s on the upside here. So that was a really nice trade. Excuse me, taking that one out. And then we just spent the rest of the week pulling back. So essentially now we're trying to balance. I think, you know, this trend is coming into play here. So I think the market is trying to balance above this trend and have another attempt at 81.50s and above. But you're seeing that that's just really failing this morning, and the market is a bit lackluster, albeit the risk is to the upside at the moment. One other thing I did want to show you on, well, before I go, I'll show you a trade I'll be looking at. It would definitely be a pullback into 79.79s for the long. If we get that, I don't think we will get that. Actually, I think there'll be buyers down here around 81.60s, we'll call it, for a long, and then we could have our last hurrah attempt at getting bid up here. And if that fails, we're going to have to find buyers back down at around 79.20s, right? But something that we use here is looking back at large amounts of data in Dun Capital for the market that we're going to trade, right? And so here, for example, just going to pull up this screenshot. I'll show you here. This is what 30 years of look back data on oil is, right? This is using 30 years of open, high, low, close and averages across oil for the last 30 years. And we see that here on the 21st which was last week, the 21st of March, we have this pullback and then we rally and cruise into highs pretty much all through April. And really, we put in our all-time high. Well, sorry, for not all-time, but the high for the year, anywhere between kind of July and October. So really, you don't want to be kind of, if you're swing trading this thing, you want to be trying to stay on the longs, essentially, as long as you don't have the macroeconomic risk to be seller, right? But I think we are skewed to the upside, and another major thing is that coming out of the bear scenario is that there are, the US rig count is dwindling and the US is actually coming off of these very high production levels. So people are watching that heavily now to see, well, if the US production level dips and starts to dip a little bit, I think it's about 13.4, 13.8 million at the moment, or maybe it's 13. But once it starts dipping, that's going to be even more bullish for oil because you have Saudi at cuts of 2 million until the end of Q2. And you have Russia who have promised to do another 480,000 barrels a day cut. And they also have in Russia 600,000 barrels offline because of these recent drone attacks. Okay, I've gone on too long. Listen, keep it lucky, keep it tight, have a good week, and I will talk to you next week, guys. All right.